Welcome to Money, Money, Money. My name is Alex Augustiniak. We'll be discussing with David Ross from Ross Accounting his role in the Dream Team as the accountant. David has a wealth of knowledge and experience and how best to structure a purchase for an investment and to discuss the various options people have available to them which they may not be aware of. Hi, Lloyd.
Hey, Alex. How's things?
Very well, Lloyd. So, money, money, money is the topic.
Yep, looking forward to it.
In last episode, part 1, we had your broker Jerome join us in the studio.
We did indeed, absolutely.
Today we've got David Ross from Ross Accounting on Sydney's Northern Beaches, 20s operating. He's currently based in Brookvale. Welcome to the show, David.
Thank you very much.
So part of our series, it's identifying the people you need around you as a property investor, and also some of the people that Lloyd works closely with when he's advising his clients. And thank you so much for joining us in the studio today. I think just to get us started, what is the importance of a good accountant, David?
Well, it's very important to get professional advisors, both legal and accounting, to review any large financial investment, to ensure that it fits with your own personal circumstances. As you mentioned, it might be a high-income owner or a low-income owner. There'll be different circumstances and different strategies that you will need to adopt. There are tax implications, whether it's positive or negative geared. And, of course, always you're looking at, and most mums and dads out there will be looking to see that whatever they invest in, they're getting a good rate of return. These days at the banks, they're not offering very much. And so property and other commodities are being looked at to get a better return. Everybody wants to be more wealthier than they were yesterday.
Absolutely. And I think, Lloyd, drawing on your experiences that you cover off on in the book Positively Geared, what's the importance of having a good accountant to you?
Well, look, certainly getting that sort of advice. I mean, I guess one of the things I cover in the book is the importance of having a good team around you in all, and I'll be covering a lot of other people during these episodes as well. But with an accountant, before you even go and source property for a client, one of the first things I do is ask them to go and see their accountant and get advice, because they really need to know what structures, what entities to buy property in. It's not just a matter of just buying a property and just buying it in your own name when that may not be most suitable for you. And also, it's often too late to go and find a property you like and then decide you want to set up a trust, which can take a few days and things like that. So getting that advice up front is very crucial.
David, it's your first time joining us. A lot of the core theme across the series that we've previously touched on, will continue to touch on, is the importance of strategy. And obviously, as Lloyd's just mentioned, you guys play a pivotal role in ensuring that things are done properly from the get-go. For the listeners today that are sort of mum and dad investors, or they're new to investing, we just want to sort of get them familiarised with some of the buzzwords they've often heard. For example, positively geared versus negatively geared. We are aware that all of this is very much circumstantial and not dependent on the individual's client's needs. But could you give us a brief run through those concepts and what they mean?
Well, Lloyd is right to make sure you have the right vehicle or financial vehicle to start the investment, and it does take a little while to set up a trust. But each person's situation is different, and that's why, again, you seek out your accounting professional to advise. As to whether it's positive or negative, again, that is a personal choice. There are benefits to negative gearing, such as taxation, but there are also some benefits of having, the money in the bank. Cash is king.
And David, when you're meeting a client for the first time, what do you look for in terms of tangible data or information to sort of help point people in the right direction?
Well, we always look to see that the wealth is growing and there's some saving strategy, and that people can continue that to achieve their goals. Because without that, they can't get that initial foothold in the property market. So it's essential people get into a systematic thing where it's harder not to save than to save, So that's essential.
Lloyd, in part 1 with Jerome, we discussed the importance of having a holistic approach if we really want to help people, break the mold and excel beyond one or two investment properties. What's been your experience in more recent times as you've sort of a lot of your portfolio started to mature, and how the accountants played a role in ensuring that you've kept on track?
Well, what's really important with an accountant is they actually need to take a look at your the holistic approach as well and what you're trying to achieve financially and where you want to be. So it's not just a matter of buying one property. And if you buy one property, you might be able to buy that in your personal name. But if you're buying, several properties, then setting yourself up with trust structures and everything is very important. And you might be negative gearing, you might be positive gearing, and the name of my book is Positively Geared, but that doesn't essentially mean all we're doing is positively gearing properties, because there's different structures and different types of strategies used depending on what suits you. And it's really important that the accountant understands what you're trying to achieve over the long term. What I also find is very important is that you're actually working with an accountant who does understand property. Is not just basically an accountant who's just doing a tax return, but they actually understand what you're trying to achieve and also what you can claim on your property. And David's going to obviously talk a bit more about things like tax depreciation and things, but it's certainly not. It's a lot more to it than just claiming interest on a property and everything like this. There's a lot of things that go into to making sure you're getting your best return out of your property.
David, when you're sort of, I guess, with some of your more longer-term clients, are there some common themes in terms of the ones that are quite, I suppose, successful in terms of building strong portfolios and the ones that are generally getting the most back from the tax man at tax time? Is there any common themes amongst those people that you work closely with?
Yes, well, making an investment in property or a series of properties, the main thing it comes down to is good management of your documentation, keeping all your receipts, your rates notices, your water rates notices, your tax depreciation schedule, your mortgage statements, all the other ancillary deductions that are available, of which there's numerous. So keeping those good records makes it easier for your accountant to claim the legitimate amount that you can claim against your revenue from the property. So good record keeping is a must.
When we look at more, I guess, advanced structures, for example, Lloyd just briefly touched on whether it be a family trust or a company entity to purchase property within. When does that conversation often come up with people?
Well, normally after the first property they buy, the family trust definitely features. The family trust is called a discretionary trust, which you can buy properties in or series of properties in. And a discretionary trust adds a layer of protection because it's managed by trustees for the benefit of the beneficiaries. And the beneficiaries don't get that right to that property until the trustees say so. That's an important feature of a discretionary trust.
David, when you're working with clients, do you find that it depends a little bit on their profession as to whether how much you're recommending a trust for asset protection?
I recommend a trust for anybody that wants any protection, even the average person for, on $100,000 or more. But some people just have it to preserve their asset that they've inherited or funds they've received by way of an inheritance.
I guess some people are worried that, if they're a brain surgeon or something and they might have a patient that dies on the operating table, they may have more of a risk of getting sued than someone who's not in such a risky sort of profession.
Well, that's right. The trust does protect that, or a limited liability may do. Company may protect. But like the bloke on the northern beaches that was a sole trader and built a retaining wall. When it blows down in the wind, they come after him rather than if you had a PTY company, then the liability is somewhat limited. The trust as much has the same effect.
So, David, in terms of, that gives us sort of a real base level understanding of possibly some uses for a trust. For those who are listening today that probably want to dig a bit deeper and identify, obviously with their own independent research, which avenue to go down, what are some of the considerations that you would typically advise a client or challenges involved with that structure should circumstances change over time?
To set up a trust, you need a set of trustees and an appointer. Now, it's very important to make sure the appointer is somebody, and that you have an alternative appointer in case of a bankruptcy, because then the appointer could be rubbed out and you get somebody else running your trust. So there's lots of things in setting up a trust that need to be discussed with your professional advisor. It is a legal document. Some solicitors set them up, accountants set them up, but we generally go through advising people, who should be your appointer, nominating your trustees and getting your beneficiaries in there. Some trusts include a beneficiary which is a corporate entity, a holding company or a bucket company. where the trustee has the discretion to give the money to any or all of those. So it may be that you've exhausted the tax limitation on the individuals and you need to give the balance of the money to the corporate trustee to hold the tax credit. So it is fairly complicated and you need to get professional advice.
And Lloyd, in your book and in your past experience building your own portfolio, were there ever instances where you were sort of faced with this decision yourself as to how to best structure your portfolio as it grew?
When I first started investing, I didn't have, as I've mentioned a few times, any professional advice. I didn't really have a strategy, buying things in my own personal names and things. And then later on, sort of, setting up trusts and starting to think more about the bigger picture and the fact that I want to be able to buy properties for my kids and pass them down and be able to distribute income through the discretionary trusts and everything like that. So that's quite important. I think the other thing that people need to be aware of, that it can be expensive if you buy property in the wrong entity and then you want to change entity later on because you might need to pay stamp duty again. Would that be correct, David?
That would be correct, Lloyd.
David, in terms of when working with the individual, high income versus low income earners, does that typically would that change the advice that you'd give them in terms of how they would often position their properties for the maximum taxation benefits?
It does. Once the amount of the disbursement at the end of the financial year is made and it's starting to exceed the limits that they're personally comfortable for. So that would change. The strategy may need to nominate more beneficiaries or a corporate beneficiary, and you can make an amendment to a deed at any time with the consent of the trustees.
Lloyd, we've briefly scraped on it, but we haven't dug too deep in terms of times in the past where you have had to look at selling an asset in order to open up the door to put money where you want it to in, I suppose, vehicles that were going to ultimately generate more income and more wealth for your portfolio. Were you ever faced with instances where you had to work with an accountant on assessing, capital gains taxes and any other sort of sundry with respect to moving?
Yes, always. That's always a conversation to have. And like with anything, you need to get that professional advice because I've sold properties along the way, and you need to look at what those implications are going to be. You've got your capital gains tax implications, and that can determine which sort of property you're going to sell, because one, depending on what sort of price you might get for it, what sort of entity it's even in, can depend on what sort of tax you might have to pay on it. So you do need to have those conversations before you sell. It helps you to decide which actual properties to sell and everything. So at every step of the way, and like I talk about in the book, you need to have that team around you. And that team, which includes the broker, which we spoke to Jerome before, and you need a solicitor, you need an accountant, and a number of other people, which we'll focus on through the episodes. But they all need to be with you through the whole process of your portfolio. So you don't just buy property and have an accountant and then decide to go and buy another property later on and find another accountant and find another solicitor. You get the same people, the same team. I like to call it the dream team. And they can work together in your best interests. And when you need some advice, and I do that, I ask my accountant for advice all the time. And if I want to know something, I ask my solicitor for advice, ask my broker for advice.
Yeah, Lloyd makes a very important point there on capital gains. You should always speak to your accountant first before you make a large shift in your investment portfolio, because you can get a deferral of your capital gain in certain circumstances before you buy the next one. So it's important to see what those time limits are for that deferral so that you don't end up unnecessarily having to pay tax on a capital gain.
Really good points. And I suppose even if we are to sort of visit capital gains tax, I mean, there's a lot of intricacies to... there's no black or white answer in accounting. For somebody listening today that hasn't sold their first investment property and they're not quite up to speed of sort of, the whole concept of that, David, do you have any advice for them or general explanation of how it works at a basic level?
At a basic level, it works that if it's just in your own name and it's a husband and wife that own the property, then a capital gain can be made at any time. If the asset's been held for 12 months or more, then you get a 50% discount on the capital gain. There are other things that take into account in terms of working out the capital gain, but that's a little bit more complicated.
We want to cover off on all the different ways that an accountant can add value to the process. Lloyd, we refer to the dream team. One of the more commonly known and discussed vehicles to purchase property through is a self-managed super fund. David, walk us through what the prerequisites are to buy through super and some of the benefits.
Well, anybody can start a self-managed super fund. If it only has one member, it must have a corporate trustee. If there's more than one, then you can have individuals as the trustee of a self-managed super fund. They're a good vehicle to have in your portfolio of other things because the tax rate in a self-managed super fund is only 15 cents on the dollar. Personal contributions and even SCG can be put into your self-managed super fund, and a self-managed super fund can borrow to purchase a property. Each of those lending rate and lending requirements are subject to the bank requirements. In these circumstances, when you buy a property, the SMS legislation requires it to be bought in a bare trust. So the bare trust, or custodian trust, sometimes called, holds the property until it's paid off and then it comes back to your self-managed super fund.
David, walk us through some of and you made a really good point before that this should be one tool in a whole toolbox of investment tools. What are some of the drawbacks and things that people need to be wary of if they're deciding to buy into super?
Well, to set up a self-managed super fund, you look at, it costs you about $1,000, and there are ongoing costs of a supervisory levy which you have to pay to the Australian Taxation Office annually, which is about $249, and there are accounting fees, and it must be audited by a ASKI auditor. So there is an annual fee, probably around $1,000 upwards. If you've got two people in it, it's not dissimilar to a super fund as like an industry super fund. So the fees are fairly transparent in a self-managed super fund as opposed to those in an industry fund.
Lloyd, in your experience and working with some of your clients, have there been instances where a self-managed super fund has been the more preferred avenue for them at that point in time?
Yeah, so I've had clients buy in both SMSF and the same clients buy outside SMSF. Sometimes it's the preferred avenue because they've got a lot of money in super. Generally, people can't really consider buying a property in super unless they've got about 200,000 or so in there. But there's certainly some good options there. There's a few rules around buying in SMSF. For example, you can't buy a property and then subdivide it inside the SMSF. So sometimes people want to do, they might want to build a duplex or something, but they can't sort of build a property inside the SMSF. That's something that's got to be done in a different entity. So there's a few rules around that. So buying the SMSF is certainly something that you'd buy as a long-term scenario. Buy something that's good cash flow that's going to pay off the property in a high-growth area. So that's where I'll be, really suggesting to people that are looking for those good blue-chip suburbs that are going to do well. And definitely had clients use their super in positive ways to do that, but also buying outside super at the same time. So they've got sort of two things running at the same time.
David, for people that are relatively new to the concept of purchasing through super, obviously through the conventional structure of a superannuation fund, whether it's an industry fund or what have you, there's obviously minimum requirements to when that money can be accessed. Is there anything differing in terms of a self-managed super fund? What does it look like when people want to possibly in the future get rid of that asset from the fund?
Yes, I get that question asked a lot of the time because some people think that they can move into the property, which they can't. It is a asset of the super fund and it must stay that way, at least until the asset is then sold and dispersed. Now, people obviously do retire. When they get to their preservation age, they can withdraw money out of the super fund, and that date ranges depending on when their date of birth is. So generally with a self-managed super fund, it's in what we call an accumulation phase. Everybody is saving up the money, all the money's going into it. But once you get to your preservation age, you can convert it to a pension phase where no tax is paid on the earnings in that fund. And that, to older Australians, that makes a lot of sense.
Who would you be recommending a self-managed super fund to at this stage?
We have them from all walks of life, from even 25,000 up, as long as they've got a strategy to save. They get their money in and they take advantage of each annual tax deduction by putting extra money into their super fund and saving, on $10,000, they'd save about $3,750 if they're earning over $80,000 a year. So it's quite a big savings to get. But if you don't take advantage of it, you don't get it.
Absolutely. So just to recap, Lloyd, you made a really good point before about people just being conscious of what they can and can't do within super. So, you wouldn't go by and try with the intention to try subdivide or to possibly redevelop. That property very much remains part of that entity, and there's not much you can do with that.
Yeah, absolutely correct.
So we're going to move on to probably a really important topic for people that are new to the investing world, and even those who are a bit more seasoned in terms of property investment. They'll either be up to speed with this or they'll want to get up to speed, and that's depreciation. Fortunately, David, you're the man to speak to when it comes to depreciating. Walk us through, what is a depreciation schedule?
Doesn't matter what structure you have in your investment portfolio, it's always a good idea to have a depreciation schedule, and those are provided by a professional, not a real estate agent or a solicitor or an accountant, but a quality surveyor. You can find them online. They normally average between about $250 and $440, and they will prepare a depreciation schedule which will span the life of the property for 40 years. It'll have capital deductions under Division 43 and also depreciation on plant and equipment under Division 40. But the rules have changed recently where properties that are not new now do not qualify for that depreciation schedule. Safe to say that if you add a new garage door or some other plant and equipment or extension or modification or renovation, then you should then again revisit whether you should get a depreciation tax schedule.
Sure, and I guess that brings it back to your point previously where it's really important to be well organised with all your receipts and documentation.
Yes, because you should hang on to that document and make sure you keep it and give it to your accountant. We file them in our own system and keep them for every year, because every year is outlined of how much you can claim as a paper deduction, and that will save you tax ultimately.
Lloyd, what are some instances during the growth of your portfolio and when working with clientele when you've had to emphasise the importance of a depreciation schedule?
I guess, Alex, firstly, is when I first started investing, I didn't even know what one was. And that comes back to what I've always said. I didn't have a strategy, didn't know what I was doing. So a few years down the track, started to learn what a depreciation schedule was. Then I had to backtrack and get some done by the quantity survey for the first couple of properties that I'd bought. And then realised I could do them for every property. Some of the statistics are around about 75% of Australians are actually not claiming everything they can on an investment property. And a lot of that comes down to the fact that they don't know everything they can claim, and depreciation is one of them. And you're leaving a lot of money on the table. You can claim on for new properties and also for second-hand properties as well. Although, as David was saying, some of the rules are be changing around that. But as my portfolio grew, I made sure that I was getting those reports all the time. And especially when we're doing developments of duplexes and stuff, then you get really good depreciation on those, because you essentially got two of everything there. Because you're building a property, you've actually got two properties there, which is really good. And that's something that's really attractive to clients. I don't advocate you should be buying an investment property or building a property just because you want to get depreciation. Tax is one outcome. It's not the whole strategy behind why you should be investing, but it's one of the things that you obviously need to look at. And having a depreciation schedule and making sure you know exactly what to claim is very important. And having an understanding of how long you can claim it for, up to a 40-year period. But also realising that you can get the better returns on the newer properties as well. So that's quite important to be thinking about that when you're investing in. I mean, there's a number of reasons why you should be investing in a newer property, and other reasons being obviously less maintenance and all those kind of things. Those things have come into play with my portfolio, and when I'm advising clients, again, I say they need to speak to their accountant. And one of the things I do when I'm helping clients grow their portfolios is I actually organise them to get their depreciation schedules for each property that they buy after they've sought the advice from their accountant.
In simple terms, what did that allow you to do, and what do you think that'll allow other people to do in the bigger scheme of things?
Well, essentially, you're getting more money back. That can help you go a larger deposit moving forward. It can help your borrowing power. There's all sorts of advantages with that. You're leaving money on the table, then you're actually disadvantaging yourself. I'm a strong believer in obviously paying your fair share of tax, but you should be doing things legally and where possible, legally claiming what you're allowed to as well. And that's one of the things we invest in property for. And, there's a lot of negative sentiment around the federal election in 2019 because people were worried and didn't know what was going to happen if Labor got into government because they were proposing all these changes, the negative gearing and, a few other things. And then it's amazing how sentiment changed and became a lot more positive when the Morrison government got back in. And that was one of the things. So having that ability to be able to negative gear properties is something that is quite attractive. And I believe it wasn't ever designed to help those people who are multimillionaires and have, lots of properties in their portfolio, but it really is beneficial to the mums and dad investors who are just trying to get ahead.
It's a really good point you make, and I mean we definitely experienced last year, renewed confidence in the markets, particularly after the Royal Commission and federal election, and I think that's a really strong reflection of the sentiment of the Australian population, the importance of negative gearing, and also the point you just touched on, Lloyd, that it really does allow mum and dad investors to get into the market and to own investment properties. It's not necessarily something designed for the 1% high-income earners in the country just to continue building a property portfolio.
I think those, the small percentage that you referred to of the very wealthy people, they don't really need the depreciation, from their portfolios. It's the mums and dads and people that are just starting out that really need that, because there's a lot of prices started to really come down in Sydney because of the Royal Commission, and then there was the election coming up, and there's a lot of factors around that, and then things started to really improve towards the end of the year, and interest rates are continuing to come down, which is, although inflation is not good, the interest rates are coming down, which is sort of pushing prices along. We've got a bit of FOMO and all that there, but I think negative gearing is definitely something that I believe is good for property investors. The last time it was abolished was the Keating government. It's the Hawke-Keating government back in 1987. And it didn't work very well then. They had to reintroduce it. So looking at decreasing that or getting rid of that again now isn't really going to help things. If anything, it's just going to be pushing up rents because landlords are going to be trying to find some other way to get their money, or people will be trying to sell, and that's not going to do much for the Australian markets in general.
David, we have seen, I guess off the back of our last conversation, renewed interest from investors entering the property market with improved lending conditions. One of the key points that we touched on in our part one of this episode with Jerome, our broker, was that there were a lot of investors that had financed interest-only loans which are now starting to get called in. What role do you play in sort of helping advise people, if any, in terms of what to do next?
Yes, well, I've had a number of those people ring me where they've had an interest-only loan, and they've just been mandated to pay principal and interest, and then they've not been able to. So it's been a matter of introducing them to a financial advisor to rewrite the loan, basically, so that they can afford and stay on their property. So we haven't had any untoward events in our firm with that. Certainly now with the interest rates falling, there's a chance for anybody that's got a high interest loan to think about refinancing and getting a better rate. In fact, it's your money, so you should always get a loan at the best rate you can.
Lloyd, what we've sort of covered off on and the state of the market, and I suppose looking at Australia in a broader sense in the last sort of 24 months, what are you encouraging all your client base to do in terms of how involved the accountant is with the whole buying and selling process?
Well, I don't think where the state of the market is has much to do with anything. The accountant should always be involved. Whether you're buying property or whether you're selling property, you should always be seeking that advice. What I need to reiterate is that you need to get that advice early on in the piece. So people might come to me as a buyer's agent, ask me for some advice about buying property. We'll talk about the overall strategy. But then the next bit of advice I give to them is go and speak to the mortgage broker about finance, and go and speak to their accountant about structure and other tax advice. That's really important before you buy the property. not when they're in the middle of trying to exchange contracts on a property, or you already got an unconditional on a property, and then you suddenly think, oh, actually, I don't want to buy it in my name. I want to buy it in a trust. That it's way too late then. And the same when you go to sell a property, get the advice beforehand, understand what the implications are, because people might think, oh, well, the market's done pretty well. I'll make some money on this property. And, if it's your own home, it's okay because there's, you don't have your capital gains tax on it. If it's an investment property and you're going to sell it and you're thinking, the market's done really well, I'm going to make heaps of money here, get some advice because you probably won't be able to pocket all that money yourself. So it's really important to speak to that accountant before you sell the property.
David, you mentioned briefly before instances with capital gains tax where possibly you can defer that over a period of time. When would you generally be recommending to a client based on a circumstance to not do that tax return for that year? Is there generally a modus operandi behind that?
Well, generally tax returns, if you're doing them yourself, which I wouldn't advise, you've got to lodge by the 31st of October, but with a tax agent that's not till May the following year. But with Lloyd's situation with a capital gain, if he's in the business of buying investment properties, we would apply for a deferral of the capital gain because then that could be rolled into another property and then eliminate the capital gain.
I think that's good. That's really good advice. Yeah.
Absolutely.
I think a lot of people probably don't know that. Yeah,
that's right. Good. Yeah, so that's a very
key takeaway.
Exactly. That's why you should speak to your accountant when you're making those big investment decisions. The other thing that I might touch on is that if you're really in a hurry to buy a property, which I don't suggest you do, but if you're going to buy a property, not sure which vehicles it's going to be in, buy it in ABC or my nominee, and then you've got the option of changing legal structures on the way, and the other side's clearly aware of that at the outset.
Really great advice there. Guys, we're running out of time. Lloyd, is there anything that you'd I guess relating back to the book that you'd like to cover off on in terms of the importance of an accountant?
Well, look, I think we've pretty much covered that. Very important. So, in the book, we talk about the importance of so many people in the team. So, the book's not just about buying property and all that kind of stuff. It's really about all the people that can help you with that. The accountant is one of those very important parts of your dream team. So, I very much recommend that you get a good accountant on your team, and if you don't have one, seek some recommendations from some people who've got one, or get in touch with me and certainly be able to help you out in that way.
David, just closing off while we've got you in the studio, I think the most important takeaway for a lot of people listening beyond what we've sort of covered off on is the importance of a great accountant versus an average accountant. And obviously in every industry, you've got your good and your bad. For what are some case studies or stories you might have about the time where you've had to sort of pick up the pieces?
Well, as Lloyd said, it's always wise to see a good accountant that is familiar with the modus operation of property. And all the deductions that can be claimed to make sure you legitimately get them all, because that ultimately can save you a lot of money. There are a lot of people that spend a little bit of money going to local tax agents that don't know a lot about it, and they end up leaving the money with the tax office. If they see somebody that they're comfortable with and an accountant that's dealt with a large portfolio of property holders, then you'll get the best outcome.
And could you put it down to, would you say that there would be a percentage which you could sort of quantify between a good versus a great accountant in terms of what they can do for you?
Well, I can't discriminate between accountants, but you need to be comfortable in your own skin with your accountant, and that you need to ask him the appropriate questions. Do you deal with clients that have a portfolio of properties, and are you familiar with tax depreciation schedules and other claims that you can make against your rental property?
Sure. I think between the broker and the accountant over our two-part series for this episode, I think one of the big takeaways that we've touched on is the importance of having a health check on your finances, and it's very easy with brokers because you can get them to review your portfolio, review your loans, but also have a health check on your accountant. Lloyd, there's probably been instances where you might have had to steer some of your clients towards somebody else because they're not getting the best service?
Yes, absolutely. And there's been a few times where clients have come to me and they've just been really unhappy, and then they've actually asked to, do I know an accountant? It's quite funny. People ask you, do you know a good accountant? Everybody says they know an accountant. Not many people say, yes, I have a good accountant, or I know a good accountant. So, but yeah, look, I have come across quite a few people who have not seeked the right advice, and things have been a bit messed up there. But from the aspect of the client and everything, I do reiterate what David was saying before. Just make sure that you've got all your records intact and give them to your accountant, because your accountant will keep them on file. So when I get my tax done by an accountant, so I don't need to have it done by the 31st of October, I get it done by May the following year and all that kind of stuff, as David was saying before. But when my statements for my real estate agents and everything come in at the end of the financial year, and everything else that's relating to my tax, I send them straight to my accountant in July, and then they're on record. So when my accountant does my tax the following year, it's all on record there. And that way, even if you're a little bit disorganised, just send it to your accountant straight away, and they'll have it on file.
Great advice there. David, thank you so much for joining us today.
That's right, thank you.
It's been a pleasure. You've given us a few really key takeaway points which listeners can now take back and apply to their own personal situations. Lloyd, I know that you've devoted a really strong segment of your book towards the importance of a great accountant. Did you have any closing comments on the topic?
Well, you go speak to David. But otherwise, look, just listen to the advice that we've tried to talk about today, and just realise that having an accountant on your team is actually really important for you.
Absolutely. Thanks very much, guys.
Right,
Thank
cheers.
you.
Thanks, Alex.
That concludes Money, Money, Money. David, Ross have shared some valuable experience. Lloyd covers off on this topic in far greater detail in his book, Positively Geared. I strongly encourage you purchase a copy of Lloyd's book so that you too can achieve your path to financial freedom.